Section 3 of Chapter 5, Dishonored Checks and Electronic Banking. A dishonored check is a check that the bank refuses to pay. Most banks charge a fee for handling dishonored checks, and the reason why it'd be a dishonored check would be if there's any insignificant funds in the bank account. Maybe the check was altered, so this would be like the amount were written or the words were not matching, or somebody rewrote over the number or the name. That would be an alter. The signature does not match what's on file for the account, or it's post-dated, so the date is in the future. Or you can always write a check for in the past date. So like I could write a check for yesterday's date, but I cannot write a check for tomorrow's date. Okay? So from our previous section, on our check stub, before we wrote here service charge. Now, if we have a dishonored check, we would write dishonored check and the amount of the check. So, journalizing dishonored checks, here's an example. You received a notice from the bank of a dishonored check from Campus Internet Cafe for $70 plus a $35 fee. Total of those two would be $105. So to journalize this, when you received a notice, dishonored check, this would be accounts receivable from that place where it's from. So they would be charged $105 to their account, but at the time, it's coming out of ours of $105 because we have to pay it. So these guys will pay us back. Journalizing electronic funds transfer, so EFT, so this would be basically kind of like an ATM, using an electronic withdrawal or electronic transfer. Okay. So an example is you paid cash on account to Kelson Enterprises for $350 using the EFT. So we paid cash on account, meaning we are paying our debt. So this becomes accounts payable to Kelson for $350. So we're lowering our debt and we're lowering our cash flow. So whether it is EFT does not matter on this part. It's just kind of saying, hey, you paid cash. Still coming out of your cash account. Journalizing a debit card transaction. So on September 5th, you purchased supplies for $24 using a debit card. Again, the debit card does not matter. It just tells you it's coming out of our cash account. When you purchase supplies, so it's increasing our supply value. So that's why it's here, supplies, increasing our supply value, and it's decreasing our cash flow. All right, let's do the work together. On March 15th, we received notice from the bank of a dishonored check from Christopher Icola, $63, plus a $10 fee because it was a dishonored check. The total was $73. So to do this, we first start with what is the date, March 15th. We received notice from Christopher, so that would be accounts receivable for Christopher. So we will increase their debt to us of $73, and we will pay it now of $73. So we will get this money back. March 16th, we paid cash on account to Spinza Enterprises for $135 using EFT. So again, it's just coming out of our cash flow for EFT. We paid cash on account, so we're lowering our debt. So it's going to be accounts payable. And we're lowering our debt, so accounts payable, normal balance is credit, so we put it on the debit side. And coming out of our cash will be cash credit. On March 17th, we purchased supplies, $31 using a debit card. Again, debit card just tells us coming out of our cash. So our supply value increases by $31. So we write it as supplies, $31. And since we paid with a debit card from our cash account, comes out of credit. And that's it. Hope you enjoyed section 3.